Today, we're going to be looking at the YieldMax ETFs, these new abominations of covered call ETFs. And I'm going to go over why not only are these going to basically destroy your financial future, but are also probably going to lead to net negative returns after dividends. So I, in one of my first videos, did basically on why no one should buy covered call ETFs like QYLD XYLD RYLD before these much higher yielding YieldMax ETFs came out. Because effectively, these provide you no advantage. You have the same risk profile as the market, as I go over here, and you can just recreate the strategy by literally just buying the underlying index and selling shares effectively to create your income, and you can get more dividends effectively, or income distributions, whatever you want to call it, and you'll get a higher return. Basically, these products shouldn't exist, period. There's really no purpose for them. So now these YieldMax ones have come out with these ultra high yields like TSLY 55%, NVDY 119%, and you have people thinking they're making all this income, and they really don't understand that they're really not really making income at the end of the day, and these will likely, even after you account for the dividends, lead to net negative returns. One such example here, which I think kind of will be the case study of when these start to blow up, is We the Khmers here. As you can see, he did his year-long review, and if you watch the video, he doesn't actually understand this portfolio, but I'll explain it very simply. His net contributions were about $86,000. He has $25,000 of unrealized capital losses, and he made $20,000 from income. And that's led him to basically, in 2023, when the NASDAQ was up 47%, the S&P 500 was up 30%, it led him to losing $5,000, or about a negative 9% return after dividends. And his portfolio has even gotten worse because he's kind of just been raising his income more, raising the income by taking out margin. And you can see now the Count's value has gone down $7,000 more, and it's effectively not going to end well. So it's these portfolios just create a slow bleed. Also, not to mention, when you have this much margin, he's paying over 10% interest on this as well. So I think in the next few years, this guy's account will just get smaller, and we're going to actually see why these funds are so bad. I'm going to dive into this a little bit more about why they're so bad, thanks to a new feature on TradingView. So before, when you just look at something like QYLD, what I went over before, you see the downtrend and people's arguments go, well, they don't care about the share price going up, you're not accounting for dividends. Well, TradingView has now created this new little feature which adjusts for dividends and basically treats it if you were to reinvest the dividend back into the stock. So this is effectively like, if you're doing kind of the snowball effect, or you're reinvesting your dividends, dollar cost averaging, whatever you want to call it, this accounts for it. So now we can take this QYLD chart, basically from 2014 to the current date, we can hit the adjust button, account for the dividends, and you say, hey, look at this, now we're actually going net up. I never said that QYLD, XYLD, or these other ones were actually going to produce negative returns. I just said they would cause you to underperform the market quite severely. And now we can actually see that a lot more easily. So we're going to now pop up QQQ, the underlying of QYLD. And you can see that, well, if you bought QYLD back in 2014, you would have produced 114% returns and probably paid a lot of taxes along the way too, and you might feel all right because you're getting the income. But the QQQ did 470%. So you have severely underperformed the market and given up a lot of gains for not really any reason, because you can see all these drawdowns, you get very similar drawdowns. It's maybe sometimes like a little bit less. You can see if we're measuring from the top here, it's like, okay, QYLD after dividends only went down 27%, and the QQQ went down like 35%. But over the long run, you severely underperform. You're missing out on a lot of gains. And we can see this with XYLD as well. Let's pop that up. And we don't need to see QQQ anymore. And you can see this is basically with the dividends reinvested, we take out the dividends reinvested, and the stock chart's gone like this, add those dividends back in, reinvest them, drip them in. We've got positive returns, but we account for it. We compare it to basically the S&P 500. And what do you have? Well, basically over this term, you've got 117% from XYLD, which is a positive return, although very low. And from basically just investing in the S&P 500, you would have had over the same period of time just under a 300% return. So you've given up a lot of gains for basically no reason at all. So let's start, well, just kind of actually show you how much the underperformance is. So what we can do also is it lets you kind of compare funds to each other in a different way too. You can go like QQQ divided by QYLD. And this is going to show us the average outperformance of QYLD or of QQQ over QYLD over time. So let's get a logarithmic chart here. And you can see over time, this is QQQ outperforming QYLD, like in 2022 when you get market corrections. A QQQ will underperform a little bit. QYLD will outperform. But on average, this has been about 10% outperformance of QQQ per year over QYLD, which is why QYLD on average after dividends reinvested, you're getting maybe a 5% return, 5-6% return per year, which is overall pretty terrible. So now let's start looking at some of these YieldMax funds. So first of all, let's look at TSLY, okay? So let's pop up TSLY here. And this is basically with dividends reinvested right now. So you can see it's down a little bit. We went up, we went down. If we take it off, and you can actually see it's going lower, 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 and then we do account for the difference. Like I said, it's not as low, but you can see that it definitely hasn't been a positive return. And just this one thing that people think, oh, well, I'm always going to be getting the same amount of income per month. Well, just look what the dividend rates were when it started. When the price was higher, you know, it's getting around closer to $1, basically in the distribution dividends. And now, well, the price is a lot lower. It's, you know, down to 60 cents, 80 cents, and, you know, 50 cents. So as the stock price goes down, you're going to get lower and lower distributions. It may always be 50%, but, you know, 50% of $100 is $50, but 50% of $1 is 50 cents, which, you know, means you're not getting a lot, you're getting a lot less money, basically. It's not a stable dividend. If you don't reinvest in these funds, your dividends will shrink over time. So let's adjust it for the dividends to, you know, be fair for these income investors, basically to show that, you know, this is what if we were taking all the dividends and reinvesting them back in. And let's compare it against TSLY. So we pop that up, and what do we see? Well, TSLY hasn't performed very well over this period since inception. It's down 10%, but well, TSLY is down 18%. And you can also kind of see on these peaks and troughs how it just slowly gets worse and worse over time. Here, it's like, you know, TSLY basically is making a high here, and it's like a little bit lower high, a little bit lower high, but these are much more severe every time. This difference between these two widens over time as we go along. Another good example is OARK, which is basically based on the ARK fund here. So let's take off TSLY here, and you can see OARK here has actually produced slightly positive returns. Again, we take off for the dividends here, it's gone down a lot. You know, it's yielding under 50 cents now, around 30, 40 cents, sometimes even lower, 20 cents. And before, when it was starting, it was $1. So if you think your $6,000, $7,000 a month income is safe, it's going to severely decrease unless you reinvest it. And, you know, you kind of get like this. But then what again happens once we compare it to the underlying ARK here? Well, basically, ARK's produced 31% since inception, where OARK has only basically produced 4%. So this is getting a much more severe underperformance. When we were looking at QYLD and QQQ, since QQQ is, I think, on average producing closer to 17% compounded annual growth per year since at least post-2009, and QYLD is 10% less than that, so it's producing, you know, 5-7%, somewhere around there. Well, here, we're at we're about 25%. So we can actually see that. We're going to take ARK, divide by OARK, and you can see I already have kind of the chart up here of this outperformance. This trend here is once we see this goes up, this is ARK outperforming OARK. And this is over a 1-year period of time. I actually need to put this into a logarithmic chart. And you can see it's ARK is outperformed by about 26% per year. So the thing is because these funds have now, these YieldMax funds have such extreme underperformance compared to their underlyings, that they will actually probably produce negative returns overall. Actually, I can almost guarantee it. Let's just take a stock like NVDA, for example. So NVDA here, it's been one of those stocks that's been going up quite a bit. But you have to realize, even though over this very, very long period of time, it's gone up so much, you have to realize that there are large drawdowns that come. Even if you bought way back here in 2015, right now, you'd be up, you know, almost 20,000%. Extremely good returns. But along that way, it's come with a 58% drawdown. It's come with here a 67% drawdown. And if you look in the past as well, there's been other drawdowns that have been 85%, 54%. You can see what I'm saying, basically. If you have a stock, and this gets into this whole concept of risk reward, you have a stock like NVIDIA, a growth company, a tech company that has more potential to give outsized returns to upside, it means you get larger drawdowns even in an overall uptrend. And this is the big problem for these funds. Like right now, NVDY, which is basically the covered call YieldMax version of these funds here, has gone up a lot. I think the investors are feeling pretty good. This is adjusted for the dividends here. You can see right now that if you bought this at inception, you're probably feeling pretty good because after your dividends, you're up 116%. You're doing really, really well. But, you need to compare that in comparison to what NVIDIA has done. And what has NVIDIA done? NVIDIA has done 210%. So now think about it. If you get a 50% drawdown in NVIDIA, and you bought basically at inception here, and there's a 50% drawdown, you're still going to be 100% up on NVIDIA because 200%, you chop those gains in half, or chop the stock price in half effectively, you only have 100% gains. But if you chop this 100% gain of NVIDIA, or NVIDIA, let's just say it's 100 rather than 115, you're actually back down to zero because that's a 50% drawdown. You lose all those gains. So that's effectively what's going to start happening. Just to show you here that the math's correct, you see if we go down about 50%, well, we're right back to inception, and effectively all your dividends you've made and reinvested, you've made zero gains. And it's because these higher volatility stocks have these drawdowns, their underperformance is more severe. So basically, this is what's just going to happen with all these funds is overall in the market, things, let's just bring up an S&P 500 here. We don't need this little channel here, but let's just take a look. And, it's like during these runs here, when things are going up like this, and if it's going up, you're going to do fine. You're just going to underperform. But as soon as you get any more of the bearish kind of times in the market, like 2022, or, 2020, or even, 2019 here, or even 2015, 2016, you start getting these things. These are when basically your big tech stocks, these, the Teslas, the ARKs, even the Apples, the NVIDIAs, the Amazons, the Facebooks, get over 50% drawdowns and are effectively going to wipe out these funds. So let's just pull this back to a logarithmic chart to make it look a little bit nicer. So, I don't know exactly when the market's going to crack. We may kind of carry on for a while, and these, income investor ETF investors are going to feel pretty good. But as soon as we get a little pullback like this, they're all going to end up with net negative returns. That's just how it's going to work. And also one effect that's even actually compounding worse on these, because in my original video here, I did go over one of the big problem is effectively with the taxes, because you are paying regular income taxes. And if you're in the US, because these dividends are so high, I'm assuming most people are going to end up somewhere in this range of paying 22 to 24%. So if you go back to the Kamir's here portfolio, when he had $20,000 of income there, on top of his normal income, he's paying regular income taxes on top of that. But he's also making losses, but they're unrealized capital gain losses. And the issue is when it's like, now he's saying that, oh, I'm making, $6,000, $7,000 a month, which might mean every year he's getting $70,000 of income. He's now going to be having to pay a 20% tax on $70,000 of income, but he's also probably going to have $70,000 unrealized capital loss. And then the problem is he's not going to have any ever capital gains to set these off, since effectively none of these funds over time are like OARK here, where, ARK has gone up 30%, but the actual fund itself, because of the dividends it's paid out, is down quite severely. You're never going to get a capital gain on these. So your capital losses, you're not going to have any capital gains to basically write off. And if you're a little bit familiar with how the US income tax law works, you can only write off $3,000 of capital losses per year against income. So effectively, while you're just spinning your wheels, making effectively no money or very little money, you have to pay taxes on all this income, but you can't write off the losses that you're losing at the same time. So not only are these funds probably like OARK and TSLY and NVDY and CONY all gonna underperform and produce negative returns, those are going to be amplified because you're having to pay taxes, and you're going to end up with effectively, you can see here, these massive, basically unrealized capital losses that go along. So it's like you haven't really made any money. He's maybe at this point made, $30,000 or $30,000 of income, but he has almost a $42,000 unrealized capital loss. So he's actually made a net loss, but he's paying a lot of taxes, and as this gets like larger and larger, the unrealized capital loss, he's never going to be able to write it off. So in a few years, basically, once we hit kind of more one of these like mini little bear markets like 2022, it's not a 2008 event, but it was a severe drawdown like that, 2019, 2015, 2016. Basically, all these YieldMax investors are going to be completely wiped out. For some of these individual stocks, such as like CONY, which is based on Coinbase, that may happen sooner. Coinbase, maybe it's going to be topping here. Maybe it's going to be start pulling back a little bit sooner. But if you look at it, what's a 50%? A 50% drawdown for something like Coinbase, which CONY is based off of, is not a very large drawdown. Anyone who bought down here would actually still have positive returns, but your YieldMax investor is going to completely have their returns wiped out. And if it does draw back here, well, let's actually look at CONY and, do the chart on it. So I'm hoping this visual way of looking at it, when we can adjust for these dividends, adjust for the reinvestment for it, kind of makes things a little bit clearer. But you can see if you start going down then 70%, well, you're actually going to be at a pretty significant net negative loss after your dividends. And you're also going to have paid a whole bunch of taxes while sitting on this huge unrealized, basically, capital loss. So anyways, I hope the little bit of charting has helped you a little bit. If you probably should go back and watch my previous video, basically why no one should buy covered call ETFs. I did a second one too about how they're going to destroy your retirement as well. I'll put those in the description. But anyways, just put this as a warning that all these YieldMax ETFs over enough time will effectively produce negative returns one way or another for their investors. And they serve zero purpose for anyone buying in the market. If you want to invest in these funds, just invest in the underlying funds. Why wouldn't you just invest in Tesla, ARK, Apple, NVDA, Amazon? You're going to get more returns and pretty much have the same risk profile. So anyways, I hope you enjoyed the video. Make sure to subscribe to the channel. Balance sheets matter. Like the video. I'm pretty sure people leave some nasty comments, although I've debunked and kind of proven that these covered call ETFs are trash in the past. But with that, I'll see you in the next video.